Accounting for hire purchase, right? You see that? Hire purchase is a transaction. Hire purchase is a transaction. Hire purchase is a transaction. So you think that hire purchase is a transaction. Hire purchase is a transaction. Is a transaction which allows for the acquisition of an asset, which allows for the acquisition, which allows for the acquisition of an asset, which allows for the acquisition of an asset, which allows for the acquisition of an asset by paying for the deposit, 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 and taking possession of the asset immediately, and taking possession of the asset, and taking possession of the asset, and taking possession of the asset immediately the deposit is paid. Taking possession of the asset immediately the deposit is paid, and taking the possession of the asset immediately the deposit is paid. Full stop. Then I say that the balance is payable in installments. The balance is payable in installment. The balance is payable in installment, and it attracts interest, and it attracts interest, and it attracts interest. It attracts interest. Then I have to say that hire purchase price is determined as follows. Hire purchase price is determined as follows. Hire purchase price is determined as follows. So how do you determine the hire purchase price? To get the hire purchase price, we take the deposit plus total installments. Or to get the hire purchase price is equivalent to the, and then you add the interest. You add the interest. For HP transaction, comma, the dealer stroke the seller, the dealer stroke the seller, the dealer stroke the seller, earns two incomes, earns two incomes, earns two incomes, earns two income, semicolon, A, normal gross profit, normal gross profit, normal gross profit, normal gross profit. And number B, interest income, interest income, interest income. Yeah, that means in that case, the seller will be earning two incomes. One, if you have said on cash price, there was a normal gross profit. Then also in this case, it's attracting interest because in this case, there's what we call the time value of money, which attract the interest. Then I have to say that, another paragraph. Interest and can be allocated. Interest and can be allocated. Interest and can be allocated using the following three methods. Using the following three methods. Interest and can be allocated using the following three methods. Number one is the straight-line method. Certain method. You see that? The interest and the interest and the interest and the interest and will be allocated equally. The interest and will be allocated equally, over the higher purchase period. Be allocated equally over the higher purchase period. Be allocated equally over the higher purchase. Be allocated equally over the higher purchase period. Number two, sum of digits. Sum of digits method. Sum of digits method. See that? The interest will be allocated. The interest will be allocated. The interest will be allocated. The interest will be allocated on the basis. The interest will be allocated on the basis of sum of higher purchase, sum of higher purchase, sum of higher purchase period, sum of higher purchase period, sum of higher purchase period. And then number three is actuarial method. Actuarial method. You see that? And this involves discounting. This involves discounting the cash flow. This involves discounting. This involves discounting the cash flow. That discount is all about getting the present value. It's all about taking into consideration the time value of money. So those are the three methods which can be used to allocate the interest. And this is what I mean. When you are saying that when you sell on higher purchase, you think that the customer will only pay for a deposit. Once he pays for the deposit, he takes the possession of the asset, and then the balance will be payable in installment. You're saying that now that balance will attract interest. So if we add that interest, how will that interest be allocated? For example, let's assume that the company was selling an item of machine whereby the interest income earned was 100,000. And then assume that the customer is to pay in 4 installments. So we have 4 installments. Now, how can we allocate that interest? Now, if you choose the certain method, you just take, we think that under certain method, you allocate equally the interest over the installment period. That means you will take 100,000, you divide by the installment period. Going to pay in 4 installments, and you get an amount of 25. What does that mean? That means when the customer pays the first installment, you recognize an interest income of 25,000. Second installment, 25,000. Third installment, 4th installment. That's what we call the certain method. Then number 2, we have the sum of digits method. And a sum of digits method, how do you allocate that interest? Now, in this case, you use the sum of installment or the sum of higher purchase payment period. That is, if the customer is to pay in 4 installments, sum of digits will take 1 plus 2 plus 3 plus 4, and you get 10. So first installment, second, third, and fourth. So for the first installment, it will take 4 over 10. Second installment, you take 3 over 10. Third installment, you take 2 over 10. Fourth installment, 1 over 10. That's how the sum of digits work. So, and then we allocate that 100,000. So that's 40%. So it will be 40,000. 30%. So that is 30,000, 20%, 20,000, 10,000. So that means if you allocate the interest using now the sum of digits method, when the customer pays the first installment, you recognize an interest income of 40,000. Second installment, you recognize an income of 30. Third installment, 20. The last installment, you recognize 10. And then number 3 is actuarial method. Actuarial method is all about determining the present value. It's all about discounting the cash flow. Good. So now let's look at methods of accounting. Methods of accounting for hire purchase. Methods of accounting for hire purchase. Methods of accounting for hire purchase. Let us say that there are two methods. There are two methods of accounting. There are two methods of accounting. There are two methods of accounting. Number one is the interest method. Number one is the interest method. So that under this method, comma, sales are recognized at cash price. Sales are recognized at cash price. Full stop. Interest is computed separately. Interest is computed separately and recognized as an income. Interest is computed separately and recognized as an income. Number two is the sales method. Let's consider. Under this method, comma, sales are recognized at higher purchase price. Sales are recognized at higher purchase price. Sales are recognized at higher purchase price. Full stop. Interest is not computed separately. Since has already been included in higher purchase price. Yeah, those are the two methods of accounting. And the interest method, you recognize the sales at cash price. Then for the interest element, you compute it separately. But sales method, you recognize the sales at higher purchase price. And in that case, you don't compute interest separately because it has already been included in higher purchase. Good. So now let's look at accounts prepared. So what are some of the accounts prepared when accounting for higher purchase? Accounts prepared. Number one, higher purchase debtors account. Number two, repossession account. And number three is a provision for unrealized profit account. Provision for unrealized profit account. Those are the three major accounts prepared when accounting for higher purchase. The major account being the higher purchase debtors. Debtor is the amount of receivable, because you're saying that it's like you're selling on credit because the customer is only paying for the deposit. Then for the balance, you'll be paying in installment. So that's the major account. So how do you prepare the higher purchase debtors account? I don't copy, just reason. Now, higher purchase debtors account. Now, being an asset, its opening balance will be on the debit side. So you have the balance brought down. Then what increases the debtor or what gives rise to debtor is the credit sales. So you add the higher purchase sales. Then what minimizes the value of your debtor? When your customer pays the amount claimable will reduce. We have the amount of cash received from the customer. Also, in case the customer default, yeah, that one gives rise to bad debt. Also, in case the company repossesses the asset, because sometimes since you are selling on credit and the customer takes the possession of the asset, but if the customer defaults to pay the amount, so in that case, remember, you as the seller, you are still the owner because you have not transferred the ownership. So you can go and you can go for your assets. So that's what we call a repossession. You repossess, and that's how you get the closing balance. Balance carried down. Then another account prepared is the repossession account. In case the company possesses an asset, so the motive is to determine whether you repossess the asset at a gain or at a loss. And how do you determine that? So a repossession account. So you'll debit the debtor's amount or the outstanding amount. So you'll take the outstanding balance at the date of repossession, the amount that the customer owed the company. Then once you repossess the item, you take that item back to the stock at a valuation. You need to value that asset. So you take that asset back at a valuation. Then, of the outstanding amount, since you had sold, the objective was to make a profit. There was a profit you expected to receive from the customer. Now, since you have repossessed, will you get the profit? You won't get the profit. Now, that's what we call now the unrealized profit. So the unrealized profit, the amount you expected to, to get from the customer, but now since you have repossessed the asset, you won't get that profit. That's what we call the unrealized profit. So you eliminate from the outstanding amount. So unrealized profit. And then you balance. If the valuation of the asset, that means it was in good condition, more than what the customer owed, that means you repossessed at a gain. So you'll have a repossession gain. But if the outstanding amount was more than the valuation, that means you repossessed the asset at a loss. So you repossessed at a loss. Those are the balancing figures. Then another account prepares provision for unrealized profit. Now, provision is a liability whereby when liability increases, that the increase in provision becomes an expense, a reduction in provision becomes an income. So being a liability, the opening balance into the credit side. So you have the provision balance brought down on the credit side. Then you compare against the provision you made at the end of the year. Balance carried down. Now, if the provision increases, balance go down to balance carried down. That change is what you take it to the P&L as an expense. The increase in provision is what becomes an expense. So those are the very major accounts prepared. And how do you determine the unrealized profit? How do you determine the unrealized profit? Now, this will determine the unrealized profit. So to get unrealized profit, you take the outstanding amount or outstanding balance into proportion of the higher purchase sales. Then you multiply by the gross profit. That's how you get the provision for unrealized profit. Now you can copy the format. NB. NB. For URP, that's the nearest profit for URP, comma, we determine both on outstanding data, and on repossession, Yeah, so that means for debtors, for unrealized profit, we'll be computing both for both the debtors and one for repossession. Good. Now let's look at differences between higher purchase sales, and installment sales. Differences between the higher purchase sales and installment sales. Sum up the schedule like that. What is higher purchase sales? What is higher purchase sales? Or is selling on higher purchase? What about installment sales? We have said what is okay. What do you understand by higher purchase sales? That's what you are discussing, Where a person acquires an asset. We have said that higher purchase sales, this is where you buy an asset and you pay a deposit. You pay the full amount. You only pay the then you go with the asset, you take the possession of the asset immediately. What about in installment sales? Now, installment sales is what you call lipa mdogo mdogo. Have you ever heard of lipa mdogo mdogo? Yes, how does lipa mdogo mdogo works? You pay, but you don't. You pay? You don't take the possession of the asset immediately, right? Yeah, it's like, for example, in most cases, you have ever seen this in supermarket. You see, maybe mostly that happens with electronics. It is written sold. Have you ever seen something like that? Sold. Unashanga. Alinunua akakosa transport. Now, what happens? Or for example, let's assume that you write this. You are dealing with the interiors. And then you ask, how much is that? Tell you this is 8,000 or 10,000. You really need it. But you only have 2,000 in your pocket. And then I tell you, ukienda ukikuja next time, hautaipata. So I tell you, commit a small amount. So what happens? Once you commit a small amount, this thing now, I indicate has been so. I deserve it for you. But I'll not let you go with it. Are you together? Yes. But for higher purchase, once you pay the deposit, you go with the asset. So for lipa mdogo mdogo, once you pay the first commitment, the item will be declared sold. It cannot be sold to someone else. So now I wait for you until you pay the full amount. Now, therefore, what is the difference between the two? And now let's look at difference number one on the side of higher purchase. Possession of the asset is immediate. Possession of the asset is immediate. Possession of the asset is immediate upon the payment of the deposit. Upon the payment of the deposit. Upon the payment of deposit. On installment sales, I hope installment sales, can you indicate it lipa mdogo mdogo so that you can understand what we mean? Yeah, that's the term we use here in Kenya. Lipa mdogo mdogo. Yeah, that's the term we use. On the other side, you're saying that on installment sales, you're saying that possession of the asset, possession of the asset, possession of the asset, it's upon full payment. It's upon full payment. It's upon full payment. Another difference for hire purchase, it attracts interest. It attracts interest. It attracts interest. On the other side, does not attract interest. Does not attract interest. On hire purchase side, it requires a deposit. It requires a deposit. It requires a deposit. Then balance paid in installment. 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 On the other side, on installment sales, no deposit, no deposit, no deposit, no deposit. All payment are installments, or payments are in installments. Or payments are in installment, no deposit. All the payment are installment. Another one on the side of hire purchase. Another one. Transfer of ownership. Transfer of ownership. Transfer of ownership is upon full payment. Transfer of ownership. Transfer of ownership is upon full payment. Is upon full payment. It's upon full payment. On the other side, transfer is immediate. Transfer is immediate. Transfer is immediate. Upon the payment, upon the payment, where was it? Upon the payment of the first installment. Upon the payment of the first installment. Upon the payment of the first installment. Another difference on hire purchases. In case of default, comma, the asset can be repossessed. In case of default, comma, the asset can be repossessed. The asset can be repossessed. I remember I said that in hire purchase, you want to transfer the ownership upon the customer has fully paid. So if it is default, you go for the asset because you have not transferred the ownership. On the other side, installment sales, no repossession. No repossession. No repossession. Why do you think is the case? No repossession in installment sales. We said what is repossession? Taking back, eh? But in this case, under installment sales, who has the possession? So there is nothing you can repossess. You are the one with the asset. Is there another difference? Yes, there is another difference. Hire purchase. Installment payments are fixed. Installment payments are fixed. Installment payments are fixed. Yeah, that means if you agree that you'll be paying 10,000, 10,000, 10,000 every month, is the same. What about you lipa mdogo mdogo? If you get 200, that's what you pay, right? If you get 1,000, that's what you pay. So you see that installments are flexible. Installments are flexible. Installments are flexible. Installments are flexible. Good. Now you can do an illustration. Take out your handout. Do a question from the handout. Handout page 11, question 1. Handout page 11, question 1. Power Limited commenced business on 1st of January 2016, the supply of refrigerators. All sales are made on hire purchase terms, with the company taking credit for the gross profit, including interest. So, including the interest in proportion to the installment collected. Throughout the year ended that 1st of December 2016 and 2017, the total price, including interest. Now, in this case, we're saying the total price, including the interest. That's what we call the sales method, whereby the sales are recognized on hire purchase. Throughout the year ended that 1st of December 2016 and 2017, the total price, including interest charged to every customer, was 50% above the cost of goods sold. 50% above the cost of goods sold. So that means the higher purchase price, the cost is 100%, and then 50% above. So that means the selling price is how much? 150%. So the higher purchase price is 150% of the cost of the item. Yeah, we told that. The total price, including the interest charged to every customer, was 50% above the cost of goods sold. Or in the case of repossessed goods, 50% above the value at which the goods were taken back into the stock. 50% above the value which the goods were taken back into the stock. Can you go back to the repossession account? Format for the repossession account. Format for the repossession account. We said that you debit the outstanding amount, then you credit what? Valuation. That means, for example, let's assume that you repossessed an item and you revalued it at 50, or let's assume 30,000, or let's assume 20,000. You repossessed an item and then you valued it at 20,000. If you have to resell it back, you resell it at how much? You resell it at? That's correct. That's why you say that in case of repossessed good, 50% above the value. So that means if you are to resell it back, you'll still sell it at 150%, 50% above the value of the good. And that means you sell it at an amount of that. That's what that point means. That, or in the case of repossessed good, 50% above the value of the goods that were taken back into the stock. So they were taken back at a value of 20. If you have to resell it again, you sell at 50% above. So that means you sell it at 150. The hire purchase contract requires no deposit and provide for payment of 12 equal monthly installment. 12 equal monthly installment. The final trial balance was extracted from the books of Lipa Power Limited as at that 1st of December 2017. There is share capital, non-current assets, provision for depreciation as at 1st of January 2017. Then there is hire purchase installment due, less provision for unrealized profit. What is that? Hire purchase installment due, less provision for unrealized profit. Write it in bracket, debtors. Those are our debtors. Those are the debtors. Yeah, those are our debtors. Yeah, those are the hire purchase installment due. We are selling on hire purchase what we have not yet received. That one becomes our receivable. And the balance was 28,350. Then we have stock as at 1st of January 2017, purchases, cash received from the customer. So that if you receive the cash from the customer, you debit the bank account, you credit the debtors account. So you say that you credit the amount of cash received. If you receive the cash from customer, that means your debtors value reduces. Received an amount of 18,625. Then we have bank balance, creditors, general expenses, revenue reserve. Revenue reserve, that's what we call retained earning. Can you write that? That is RE, retained earnings. Retained earnings. That's the retained earnings. Added information. The sales, including interest for the year ended that 1st of December 2017, 194,650. Those are the sales for the year. Remember, we're setting on higher purchase. So that means our debtors will increase so that you debit higher purchase sales. You debit the debtors account, you credit the P&L as the value of the sales. So we sold goods worth 94,650. Number 2. In October 2017, the company repossessed some goods. So there was a case of repossession. So in case there is a repossession, now reason up here, in case there is a repossession, if you repossess, remember you had sold. So the amount you expected to receive. Now you have repossessed, you don't expect to receive the amount. So you eliminate the amount. So repossession. Then you debit. You want also to determine whether you repossess at a gain or loss. So how do you prepare the repossession account? So take the debtor's outstanding amount. Outstanding amount. Then you take that item back to the stock at a valuation. You value the asset. Then of the outstanding amount, there was unexpected profit, which you'll never recover. So that's what we call now the unrealized profit. So we also eliminate the unrealized profits. Good. Way number 2. In October 2017, the company repossessed some goods, which had cost 4.8 million and had been sold earlier in the year. The unpaid installment on this good amounted to 2.4 million. The unpaid amount, that was the outstanding amount. So the unpaid amount was 2.4. So that one you eliminate because you'll never recover. Then you credit there, you get the possession account. The outstanding amount was 2.4. So I told that was the unpaid installment on this good amounted to 2.4. In respect of which nothing was recovered apart from the goods, which were taken back into the stock at a valuation of 2 million. They were taken back to the stock at a valuation of 2 million. Now, if you had to sell this good, the repossessed good, you have to sell them again. You sell it at how much? Sell it at how much? Is that at how much? Yeah, 3 million. That means it's 2,000 and then 50% above. So you multiply by 150. They'll sell it at 3 million. Good. Then after that, the repossessed good were resold before the end of the financial year. So they repossessed and then they sold it. Yeah, the repossessed goods were resold before the end of the financial year. The total selling price, both on the original sales and on repossession, on sale on repossession, and repossessed good, were included in the sales for the year ended that 1st of December 2017. Number 3. Number 3. All installments were paid on time, except for those referred in note 2 above. All goods unsold as at that 1st of December 2017 were in good condition and were to be valued at cost. Provision for depreciation on non-current assets were to be provided at the rate of 10% per annum on cost. Quiet. Income statement for the year ended that 1st of December 2017 and the statement of financial position. Now, before we prepare the financial statement, let's close our account so that we determine the balance carried down. How much will be the balance carried down? Sorry? That's 9? 975. And then for repossession, first of all, you have to compute the unrealized profit. And how do you compute the unrealized profit? Is that to get the unrealized profit, you take the outstanding amount, then you divide by the higher purchase sales, then you multiply by the gross profit. And I gave you a point to note that for unrealized profit, we compute both for who and who? For debtors and on repossession. Good. So you compute unrealized profit on debtors. Also, you compute unrealized profit on repossession. Let's start with the debtors. To get unrealized profit, the outstanding amount for the debtors, this outstanding amount, the balance carried down, which is that 9,975. You divide by the higher purchase sales. The higher purchase sales for the year was an amount of 94,650. Then you multiply by the gross profit. How do you get the gross profit? It's very simple. This is how you argue. This is how you argue. This was the higher purchase sales. 94,650 was the sales, which is equivalent to 150% because the higher purchase price was 150. What about 100%? So that now we get the cost. How much was the original cost? 63? Yeah, that was the cost of the goods. So therefore, how much was the gross profit? So you take 94,650. You deduct the cost of 63,100. That means they had made a gross profit of how much? That one? That 153. Simple. So you multiply by the gross profit. So the gross profit on these sales was an amount of that 1,550. That 325. Good. So the annualized profit on that is 13,325. Let's do the same. Annualized profit on repossession. The formula is the same. You take the outstanding amount. Now, the outstanding amount on repossession was 24. You divide by the higher purchase sales. So how much was the higher purchase sales on repossession? Can you go back to note number 2? Let's go back to note number 3. In October 2017, the company repossessed some goods which had cost 4.8. So the 4.8 was the cost. So what we need is the higher purchase sales. So if you want to determine how much was the higher purchase sales, if the goods cost was 4.8 and you are selling at 50% above, so you multiply by 150. So that means if the 4.8 was the cost of the goods, we had sold them at how much? Remember, you're having a profit of 50%. You add 24, that's 7,200? Yes. Good. So that means if the cost was 4.8, the higher purchase sales on those goods, we had sold them at 72. So we take the outstanding amount, 24, you divide by the higher purchase sales, which was 72, then you multiply by the gross profit. They had made a gross profit of how much? They made a gross profit of how much? Yeah. Gross profit, you take 72 and the cost was 4.8 and you get an amount of 24. 400 times 2 you get? You get 800. So that means, this is what I mean. I want to explain you understand. This was the outstanding amount at the date of repossession. But on this, the expected profit you expected from that amount from the customer was an amount of how much? 800. I don't know whether you're understanding what I'm saying. The customer owed you 2,400. Are you together? But of that 2,400, the expected profit in that amount was how much? 800. So how much was the cost of those goods? Don't use a calculator. That one do go ahead. The customer owed you 2.4. The profit you expected on that was 800. So how much was the cost of those goods? The cost was 16, correct. Then if the cost was 16, then you took that item back to the stock at a valuation of how much? 2,000. The cost was 16, but you valued that item at 2,000. Do you value it again or loss? Again of how much? 100, correct. So this is what I mean you balance. So this is 28. This is 28. And we have a balancing figure of 4. And that's what we call the repossession. Okay. So now you can answer our question. So number one, you have to prepare the income statement for the year ended that 1st of December 2017. So we start with the sales. So we have number one. Can you go back to note number one? Note number one, you're told that. The sales, including the interest for the year ended that 1st of December 2017, were 94,650. So it's 94,650. Then you deduct the cost of sales. How much was the cost of sales? Here are the cost of sales. 94,650, this was the sales, was equivalent to 150%. What about 100%? 100 will give us the cost. So the cost was an amount of 63,100. So how much was the gross profit? The gross profit was an amount of that 1,550. Then we have other income. We repossessed an item at a gain. So there was repossession gain. And the repossession gain was an amount of 400. Then we deduct expenses. One is the provision for unrealized profit. Now we see that increase in provision becomes an expense. And we have the provision for unrealized profit. One was URP on debtors, an amount of 13,325. Also, there was unrealized profit on repossession, an amount of 800. That one you get is 14,120. 14,125. And then let's go back to the 12 balance. Can you see any other expense? The second last item, what do we have? Yeah, there was general expenses, an amount of 16,150. Number five. Provision for depreciation on non-current assets were to be provided at the rate of 10% per annum on cost. So depreciation of non-current assets, 10%. How much was the cost of the non-current asset? 10,000. So therefore the depreciation was an amount of. So now give me the profit. That 675. 675. Or alternatively, sometimes the examiner might require you to prepare them in a parameter format, showing the original sales and the sales on repossession. How can you show that? So while separating the sales, that is for the original sales and sales on repossession. Now, the sales for the year was an amount of 94,650. Let's read number 2 again. Number 2 to that. In October 2017, the company repossessed some goods which had cost 4.8 million and had been sold earlier in the year. The unpaid installment on this good amounted to 2.4, in respect of which nothing was recovered apart from the goods, which were taken back into the stock at a valuation of 2 million. Yeah, so we took them back to the stock at a value of 2. And the repossessed goods were resold. So we sold them afterwards at an amount of how much? 3 million. It's 50% above. So you multiply by 150 since they were resold before the end of the year. So that means the repossessed sales was an amount of how much? 3 million. You are told that? The repossessed goods were resold before the end of the financial year. The total selling price, both on original sales and on resale of repossessed goods, were included in the sales for the year. They were included here. So that means if you want to determine the original sales, you take 94,650, and the sales on repossession was 3 million. So that means how much of the original sales? 91,650. And that's how now you get your total sales. I'm showing you this because sometimes the examiner might require you to show them different. And the total sales now will be 94,650. What about the cost of sales? Also for the cost of sales, you do the same. Cost of sale based on the original sales and sales on repossession. Original sales, these are original sales. You just say that 91,650 is equivalent to 150%. What about 100%? How much is that? $61? Cost of sale on repossession. Now, this one will be the cost. Or you can argue that the repossessed sales was 3,000 is equivalent to 150%. What about 100%? And 100% you get is an amount of 2,000. And the total cost of sale now will be 63,100. And that's what we handle. And the gross profit was an amount of 31,550. Yeah, then from there now you can factor in other item, repossession gain, and the expenses. And now let's finish up. Number B of the question. Statement of financial position. Prepare the statement of financial position. So we have the non-current assets. Now, how much was the value for an non-current asset? It was 10,000. Then you deduct depreciation of how much? Yeah, 2,000, correct. That was 1,000. Yeah, the teacher is always right. Why? Yeah, by the way, it's 1,000. Eh? It's 1,000. Can you go back to have the non-current asset? Can you see that? Non-current asset is 10,000. Then there is provision for depreciation as at 1st of January 20. That was the depreciation by the beginning of the year. That's what you call accumulated depreciation at the beginning of the year, 1,000. Then you deduct the depreciation charge for the year, which is an amount of 1,000. You get 8,000? Yes. What do you have to the current assets? Number one, we have debtors or the receivables. We have the debtors, and for the debtors, you take the balance carried down, which was an amount of 39,975. Then you deduct. On this outstanding amount, there was unrealized profit on debtors. So we made the unrealized profit, an amount of 13,325. Since the amount was expensed to the P&L. So how much is that? That's 26. 650. Did we have any cash or bank? We have bank balance. How much is the bank balance? Bank balance was an amount of? Yeah, can you stop writing? 65. And then we have inventory. We have the inventory or the stock. How much is our stock? Now, then we have equity and liability. Now, the equity and liabilities, we have the ordinary share capital. How much is the ordinary share capital? Is it an amount of that 5? 35. Then you add retained earnings. For retained earnings, that's the revenue reserve was an amount of 51.15. And then you add the profit for the year, which was an amount of 675. And you get 57.9, right? And then we have liabilities. Liabilities. We have creditors. Creditors. Greater amount is an amount of 48. 48.60. Let's add the total. Give me what you're getting. Which one? 45? 650? 650. 47? It's not balancing. 47,750. There's a difference of. How much was our stock? 6,600, of which that's very wrong. Yeah. See, that was the stock as at 1st of January. Yeah, that's the opening stock. What we need is the closing stock. To get the cost of sale, how do you get the cost of sale? Opening stock plus purchase minus closing. Now, what we need is the closing stock. We take it to the other side. So, closing stock is opening stock plus purchase minus cost of sales. How much was the opening stock? The one which is 66. Then you add the purchases. How much was the purchases? 59. Then you deduct the cost of sales. Now, listen up for the cost of sales. Now, the cost of sales was 63,100, but of this one include the cost of repossessed good. What, how much? 2,000. The cost itself altogether. So take 63,100, you minus the value of the repossessed item 2,000. Or alternatively, how much do you get? 61,100. Or you take the cost of sale of original sales. Cost of sales of the original sale. This one exclude this 2,000, which was an amount of 61,100. How much is that? 4,500. So that means our closing inventory was 4,500. So how much will be the total assets? Sorry? 5,650. Good. Can copy now? November 2017. November 2017. Question 5B. Wajareda Limited is a mid-sized firm selling electronic keyboards, both on cash and hire purchase terms. The following information has been extracted from the firm's books of account as at 30th of September 2017. So we have the share capital, general operating expenses, we have the cash balance, cash recovered from the hire purchase customer. So for the cash recovered from the customer, you create the debtors account. So we have cash received from our customers, amount of 157,734. And then you have the cash sales, hire purchase trade receivables. Those are the debtors, balance brought down. Yeah, so hire purchase trade receivable that 1st of October 2016 is an amount of 1134. Property, plant, and equipment, we have accumulated depreciation, we have retained earnings, provision for unrealized profit, we have the purchases, trade payables, and then we have inventory as at 1st of October 2016. That's the opening stock. Additional information. The company policy is to take credit for gross profit, including interest, for the hire purchases in proportion to the cash collected. It does this by raising a provision against the profit included in the hire purchase trade receivable not yet due. So in short, they are saying that they provide for provision for unrealized profit. Number 2, the cash selling price is fixed at 50%. The hire purchase price at 80% respectively against the cost of goods sold. So the cash price is 150% and higher purchase price is 180%. Number 3. The higher purchase contract requires an initial deposit of 20% of the higher purchase selling price, and the balance is to be paid in 4 installments at quarterly intervals. The first installment is due 3 months after the agreement is signed. 4. Higher purchase sales for the year amounted to 70 million, the higher purchase sales. So that only increased our data. So we say that you add the higher. So 70. 5. Depreciation is charged on property, plant, and equipment at the rate of 15% per annum on cost. 1/3 of depreciation relates to cash sales. 6. Operating expenses are to be apportioned on the basis of cash and higher purchase sales. Required. Prepare for the Jareja Limited. 1. The income statement for the year ended 30th of September 2017, showing separate columns for cash, higher purchase, and combined sales. And number 2 is a statement of financial position as at 30th of September 2017. So first of all, let's close the balance. This is 271.34. Now, in this case, there was no repossession. So how much is the balance carried on? 113,400. And then we provide for unrealized profit on the closing data since there was no repossession. Say that unrealized profit, you take the outstanding amount, you divide by the higher purchase sales, you multiply by the gross profit. So the starting point for debtors, so we have it 113,400. You divide by the higher purchase sales, which was 270. Then you multiply by the gross profit. How do you argue? The higher purchase sales was 270. This is equivalent to 180%, or about 100%. So first of all, you get the cost of sales. 150. Therefore, to get the gross profit, it will take 270 minus 150, and you get 120. So the gross profit was 120. So of this 120, how much will be unrealized? 50? 5,400. Good. Now we can answer the question. You have to prepare the income statement for the year ended 30th of September 2017, showing separate columns for cash, hire purchase, and combined sale. So so we start with the sales. How much was the cash sales? It's an amount of 36,000. Hire purchase sales was 270, and the total is 346. Then you deduct the cost of sales. And now for the cost of sales, we start with the cash sales. 36,000 is equivalent to 150%. What about 100%? That's that. Is it 24? Then for the higher purchase sales, we already have it. For the higher purchase, 270 is the same as 180. What about 100? So it's 150. And the total is an amount of 174. And that's how we get the gross profits. Here we have is 12, 120, and the total is 132. Then we can deduct expenses. For expenses, number one, there is provision for unrealized profit. Provision for URP. How much is the provision for unrealized profit? The provision for unrealized profit on debtors is an amount of 50,400. Now there is something I mentioned about the provision. We see that an increase in provision is what you take it to the P&L as an expense. Can you go back to the format? Go back to the format where you prepared provision for unrealized profit account. Yeah, we say that the opening balance will be on the credit side. Then you compare against the closing balance. The balancing figure is what you take it to the P&L, the increase. Let's go to the trial balance. Go to the trial balance. Can you see the provision of unrealized profit at the beginning of the year? It was an amount of? So you have said yes. It was an amount of? 504. So the provision for unrealized profit at the beginning of the year is 504. At the end is 50, 400. The increase in provision is what we call an expense. So the other question we did, there was no opening balance, so it was zero. So how much was the increase? 49? Good. But now that expense, how will you apportion? How will you apportion? In the ratio? How will you apportion? I wanted to see whether we are together, but I can see we are not together. Now, this is what I mean. Provision for unrealized profit. If you sell on cash, you realize your profit. Are you together? If you sell on credit, what you expect to receive in the future, that's what you call unrealized. So this is purely an expense for the higher purchase sales. If you sell on cash, you realize your profit immediately. So the unrealized profit will go here. So an amount of 49,896, and then the total will be 49,896. Then there was general operating expenses. How much is the general? Can you see the general expenses? Yes. Yeah, the general operating expenses was an amount of 60. Yeah, it was an amount of 65. How was it allocated? Now let's go to note number 6. Note number 6. Note number 6. Operating expenses is to be apportioned on the basis of cash and hire purchase sales. So that means these were the sales. Cash sales, hire purchase, that was 306. If you have to get for cash, you'll take 36,000, you divide by the total, which is 306. Then you multiply by 65,000. Then to get for hire purchase, you take 65 minus this, or you just take 270. You divide by 306 times 65. Now give me that. Sorry? 47. Then you take 65,000 minus the answer. You get 50. 57. 350. 3, and the total is 65. Note number 5. Note number 5. A depreciation is charged on property, plant, and equipment at the rate of 15% per annum on cost. 1/3 of the depreciation relate to the cash sales. So depreciation on PP at the rate of 15%. How much is the value of PP? 50,000. So that's 5,000 plus 25, you get 75. Then AVAD relate to the cash sales. AVAD of 75 is 25. That means 2/3 go to the higher purchase. Give me the profits. Combine this. 9604. And this is 1047. You compare against 12. You get 10? 18? 53. 77. 51. Number 2 of the question. Now, number 2 to prepare the statement of financial position. So for non-current assets, we have PP. PP, the cost was 50,000. Then you raise the accumulated depreciation. How much is accumulated depreciation? How much is accumulated depreciation? 75 was depreciation for the year. Just check from the trial balance. An amount of 22,500, and then you raise depreciation charge for the year 75. That is 30. The balance will be 20. Then we have the current assets. Current asset, we start with the debtors. How much was the debtors? It's not there, it's here. Amount of 113,400, but we made the provision for unrealized profit on debtors. Of this 113,400, the unrealized profit was an amount of 50,400. Yeah, because this amount was expensed. So how much will be the balance? 63,000. Did you have any cash or bank balance? Yes. Yes. We have cash balance, which was an amount of that 104. Then we have inventory. We work with the normal formula that cost of sale is opening stock plus purchases minus closing stock. Can you be able to get the closing stock? Closing stock is opening stock plus purchases. You deduct the cost of sales. How much is the stock? Inventory as at 1st of October 2016. That's the opening stock. Was an amount of 70. Then you add the purchases, and the purchase was an amount of 171. Then you deduct the cost of sales. How much was the cost of sales? Yeah, the cost of sale was an amount of 170. 174. So 375, that is 40. 45. Good. Give me the total. $96 of good. Equity and liabilities, we have ordinary share capital. The ordinary share capital, the amount of that 7,500. Then you add the retained profit. So we had the retained earnings as at the beginning of the year, which was an amount of 3,500. Then you add profit for the year, an amount of 96, and you get 13,104. 13,104. Then lastly, we have liabilities. Liabilities only the current liability. What can't you see? Trade payables. And the trade payables was an amount of, is it 40? 40,000. 96. So you can copy now. Now, someone is asking how we got operating expenses of 65. It's in the trial balance. We are told the general operating expenses was 65. Then someone is asking depreciation, we should take 50 minus 22.5, then 15%. That's not correct. Use that one if you're using reducing balance. So straight line, you take 15% of the cost.